Gold didn't just hit $4,200. In the same quarter, the BIS ran a different calculation, one that ignores price, politics, and predictions. It asked, how much domestic currency debt does a country hold per ounce of LBMA gold? And for Turkey, Argentina, and Nigeria the answer wasn't high. It was catastrophic, 1,200 times over the safety limit. That number isn't a forecast. It's not a warning. It's not even a rating. It's a * disqualification. Published, verified, enforced, because Q1 2026 wasn't the launch of a new metric. It was the first full quarter of binding arithmetic the moment the Gold Indexed Liability Ratio, or GILR, went from theory to triage protocol. Here's what changed. The BIS didn't build a dashboard. It wired a switch. GILR uses only the LBMA gold fix, the exact same 3 p.m. GMT price that triggers margin calls at central banks worldwide. No averaging, no discretion, no exceptions. That means when gold spiked to $4,200, the same price that forced collateral top-ups in Frankfurt and Tokyo, it also recalculated sovereign eligibility in real time. Every single day. For BIS Working Paper 2025-007, these calculations run daily, but the asterisk breach is published quarterly. So the numbers were live long before they appeared in the April 2026 quarterly review. Which means Turkey, Argentina, and Nigeria weren't flagged in April. They were disqualified by April. Let that sink in. This isn't macro commentary. It's structural triage. The threshold? 1,000x domestic liabilities per ounce of official gold. Cross it, and you're mathematically ineligible for full access to the dollar system. Not at risk. Not under review. Ineligible. Think about that. What happens when your solvency test runs on the same clock as your margin call? When the same gold price that moves your collateral also gates your SWIFT access? When the ounce stops being an asset and becomes the asterisk accounting unit that decides whether your payment's clear? That shift didn't happen in a speech. It didn't require legislation. It activated silently on April 1, 2026, the moment the BIS terminal output its first live GILR report. And 3 countries walked into the wrong room. They didn't get disqualified for borrowing dollars. Turkey didn't default on a single dollar bond. Argentina didn't miss a single Eurobond coupon. Nigeria didn't breach a single IMF covenant. So what did they do? They printed too much of their own money. Not in dollars, not in euros, in asterisk liras, pesos, and nairas. And the BIS didn't punish them for that. It measured it in ounces. Domestic liabilities aren't just government debt. They're all money created in local currency. M2. Local currency T-bills, municipal bonds, central bank reserves held in pesos, every lira in circulation, every peso in a savings account, every naira in a mobile wallet. That's the numerator in GILR. And the denominator? Official gold holdings, fixed, immutable, measured in asterisk ounces, not dollars. Turkey's M2, $1.20 trillion. Its official gold, 517 tons. That's $2.3 million per ounce. Argentina's M2, $78 billion. Its official gold, 62 tons. That's $1.26 million per ounce. Both sit at 1,200 times the 1,000x safety threshold. Let that sink in. This isn't about debt to GDP. It's not about credit ratings. It's not even about inflation rates. It's about how many local currency promises you've made per physical ounce of gold. So what happens when your central bank prints 20% more pesos next quarter? Nothing changes, except the ratio gets worse. Inflation doesn't shrink GILR. It's like trying to lower your BMI by inflating the scale. The ounce doesn't care how many zeros you add. Here's where everything you thought you knew about financial risk flips upside down. Risk isn't where you think it is. The BIS didn't rank countries by debt, deficits, or GDP. It ranked them by how many domestic currency promises they've made per ounce of official gold. And the resulting map published in the April 2026 quarterly review doesn't look like any risk chart you've ever seen. Germany's GILR is 0.8x. That's not low, that's less than 1, which means in dollar terms Germany's domestic liabilities are smaller than its gold holdings. It holds 3,364 tons of gold. Its M2 is $4.10 trillion. So each ounce backs just $1.20 million. Turkey? Each ounce backs $12 million. That's 10 times more, and it's why Turkey's GILR is 1,200x. But Germany's 0.8x isn't conservatism. It's structural immunity. Think about that. When your gold outweighs your money supply physically, in ounces, you're not preparing for crisis. You're insulated from it, because the system no longer asks how much you owe. It asks how much. Gold stands behind what you've printed. Switzerland's GILR is 1.3x. Singapore's is 2.7x. These aren't cautious economies avoiding risk. They're gold-leveraged bankers, not borrowers. They hold gold not as a hedge, but as capital, the same way JP Morgan holds treasury collateral to issue loans. They don't borrow against gold. They lend from it. That's the inversion. Now look at Argentina. Its debt to GDP is 85%. On paper, manageable. In GILR terms, 1,200x. One metric measures political capacity. The other measures gold-backed solvency. And the BIS just proved decisively which one the dollar system trusts. What if the safest country isn't the one with the lowest debt, but the one whose gold outweighs its money? That's not theory. That's Germany's balance sheet, live, verified, and now enforceable. This isn't about wealth. It's about weight. Gold weight. And for the first time since Bretton Woods, weight, not words, decides who gets through the gate. So when the next liquidity crunch hits, who do you think the Fed will prioritize? The country that prints 1,200 promises per ounce? Or the one that prints less than one? It happened at 3:02 p.m. GMT on April 15, 2026. A Turkish commercial bank attempted a $500 million cross-border repo using U.S. Treasuries as collateral. The trade cleared. Then, instantly, 40% of the collateral value vanished. Not reduced, not renegotiated, slashed. By algorithm, by mandate, by the gold-indexed liability ratio GILR crossing 1,000x. Per BIS Working Paper 2025-007, that breach triggers mandatory collateral haircuts effective immediately upon quarterly publication. No hearing, no appeal, no discretion, just arithmetic enforced. That 40% haircut isn't punitive. It's asterisk structural. Same haircut applied to hedge funds during the March 2020 liquidity crisis when margin calls spiked across prime brokerages. But this time, it wasn't volatility that triggered it. It was ounces. Turkey's 517 tons. Argentina's 62. Nigeria's 45. Measured against their domestic liabilities M2, local bonds, central bank reserves, all denominated in liras, pesos, nairas. And the math didn't lie. 1,200 times over the limit. So the system responded not with warnings, but with levers. Now, interbank lending, Turkish, Argentine, and Nigerian central banks no longer access USD swaps on equal footing. They face mandatory 72-hour settlement delays. And a mandatory 300 basis point premium, that's 3% extra just to borrow dollars overnight. Think about that. In normal markets, that spread is 10 to 20 BPS. Here, it's 300, because the system no longer asks how much you owe. It asks how many promises you've made per ounce. And when that ratio hits 1,200x, you don't get a warning call. You get a price tag and a wait time. This isn't policy. It's protocol. And it's live. Now the quietest consequence. SWIFT. Not banned. Not cut off. Deprioritized. Internal BIS settlement logs dated April 15, 2026 confirm it. Payment instructions from institutions in GILR breaching jurisdictions now enter the lowest priority queue. No flags. No alerts. No notifications. Just slower. A $20 million oil invoice from Lagos? Delayed 37 hours. A $120 million import letter of credit from Buenos Aires? Held for manual review adding 2 business days. A payroll transfer from Istanbul to German contractors? Processed after all GILR compliant flows even if submitted first. This isn't about speed, it's about hierarchy. And hierarchy is now measured in ounces. Germany's GILR is 0.8x. Its SWIFT traffic clears in under 90 seconds, same as the ECB, same as the Fed. Turkey's median latency, 18.4 hours. That's not infrastructure failure. That's enforcement. This is phase 1. No speeches, no sanctions, no headlines. Just silent, daily, LBMA-sourced arithmetic rewriting who gets paid, how fast they get paid, and at what cost. Gold didn't just become money again. It became the asterisk unit of account that governs access. And for Turkey, Argentina, and Nigeria? Access isn't revoked. It's asterisk priced. It's asterisk delayed. It's asterisk downgraded asterisk by the ounce.